Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
And good evening. I'm Michael Hartzman. Today is Tuesday, August 24th, 2021. And as always, I'm on with my partner, Dominick Tavella. How are you, Dominick?
Doing great, Michael. How are you?
I'm all right. Grateful that we avoided a hurricane on Long Island this weekend.
It's not supposed to happen. I think the last time we got hit was 30 some odd years ago, not counting some of the tropical storms that have hit us, but we were very fortunate and blessed that it kind of stayed offshore, and for the most part, most of Long Island came through it unscathed. So that's a blessing.
I want to come back as a weatherman. They get paid well, they have great hair, and they have to be right about 25% of the time.
No commentary on the hair, but if we needed to be that level of accurate on our portfolios, we'd be in trouble, Mike. So
we would be in big trouble, Dom. Exactly.
So
exactly.
I think our calls are a little bit better, and we'll look to a brighter future, weather and portfolios.
Well, speaking of portfolios, again, I get to quote the great philosopher Yogi Berra. It's deja vu all over again. The market again closed with the S&P and NASDAQ at all-time highs. And I seem to say this every week.
I do use the word frustrating intentionally here. So we started what looked to be finally a little bit of a pullback in these markets. We've talked about that we haven't seen a 5% plus correction in over 200 days. And so it looks like we're finally going to get this little rollover last week. And before you could even blink, it turns around on Friday, upward momentum yesterday, positive day today, and that correction pullback did not happen again. So it's been a very unusual year in these markets, and we'll talk to some experts today and in the future about why, but very frustrating. As a portfolio manager, this is very annoying and frustrating.
And it's a little bit of a dichotomy about that. I was reading a report from JP Morgan earlier today to get ready for the show, and they were talking about how consumer sentiment is really pretty low. I mean, it's lower than it was prior to the pandemic. And normally when we have less than enthusiastic investors, the market sometimes reflects that. And even consumer sentiment hasn't been able to curb the appetite of investing.
So we had two things that kind of put a little bit of a depression in the market's mood last week. And the first is that, the COVID, this variant looked like it was getting worse. And the number of new cases on a weekly basis has been going up and up and up. And so from a mood perspective, consumer perspective, I think consumers were starting to get a little bit worried, Mike, and consumer confidence was ebbing a little bit. And obviously the consumer represents 70% of the economy. So if the consumer starts to draw back their spending, that's a direct effect on the economy. And then the politics situation around here in the US and around the world and Afghanistan. I think the general mood of the public out there was starting to get a little bit negative, and that was reflected in the numbers that you just stated. But then we had some pretty positive news on COVID and the vaccine being approved, and that changed the mood right around, and off we went again.
Off we went. And the other thing is we both received a note from Dr. Seidel, who's known on Wall Street as a perma bull. And, he said, and he's a little cautious. He thinks we're going to have a little bit of a correction, but he did say at the end of the day, there are still very few alternatives to stocks, with long-term bonds providing very little competition in the market, end quote. So I think that also has something to do with it, Dom, as well. There's not many more places to put money.
Yeah, look, Mike, we get you as well as I, we get calls almost every day from existing clients, new clients, and where do I put my money, right? So banks are paying virtually nothing. Short-term government bonds are paying virtually nothing. And we are literally sitting with an excess of maybe as much as $5 trillion sitting in banks, earning virtually nothing. People are looking for alternatives where they can make that money work. So even if we get a dip in the market, it doesn't last for very long. The dip is not very deep, and money comes rushing in to buy it. And you've talked a lot about this, Mike.
Yeah, I have. And we're going to talk to an expert tonight. We are fortunate to have Richard Koerner, who's a senior vice president at Fidelity. He was a guest on in the winter. He had some thoughts about the market at that time. And we're going to bring him back this evening to kind of give us an update. And we're going to talk a little bit about the growth and value rotation and some of the sectors he likes and dislikes now.
Yeah, he gave us some terrific advice, and I think we took advantage of it in our allocation. We're going to bring that up with him, and it's worked out very well for us. So definitely interested in what he thinks going forward, and maybe he can give us some more tips of what we can do to add value to our client portfolios.
Well, I'm certainly planning on that, and we will be right back after this break.
Are you paying federal taxes on your cash? I work hard for my money that I keep in cash. And for the life of me, I can't imagine why anyone would want to pay federal taxes on their cash. That's why I keep my cash in the Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX, le tax.
Rates on cash are already so low, why pay federal taxes on the interest your cash earns? Remember, it's not what you earn, it's what you keep. The Lebenthal Ultra Short Tax-Free Income Fund, LETAX, may help you earn more on the cash you've worked hard for and keep more after-tax dollars in your pocket. Find out more about the fund by speaking with a Lebenthal Global Advisors private wealth advisor or its sponsor at dcmadvisors.com.
For your hard-earned cash, why pay the tax when there's the tax?
Lebenthal Ultra Short Tax-Free Income Fund. It's not what you make, it's what you keep. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Dominick Tavella and our special guest this evening, Richard Koerner, Senior Vice President at Fidelity. How are you, Rich?
I'm good. Good to be here with you guys.
Welcome back, Rich. You were pretty valuable to us the last time we spoke to you. So looking forward to sharing some of your wisdom again tonight.
Yeah, I'm excited to be here.
Well, thank you. So we'll just kind of jump right into it, put you on the spot. When we saw you in the wintertime, value was all the rage. Vaccines were coming online and things were going to get back to normal and no more masks and hallelujah. And some of it came true and some of it didn't come true. But growth has seemed to come back in vogue. So let's just get into that a little bit. You know, what changed the dynamic between value losing a little steam and growth picking up ahead of steam?
And Rich,
I think all this pretty much coincided with the peak in the 10-year Treasury at the end of the first quarter, almost topping out there at 175, and then all of a sudden there was concerns about growth in the economy, and 10-year Treasury now today in the 125 to 129 ish range, and so you saw this rotation kind of leave the cyclical sectors, and certainly now, I'd say maybe prior to this week, or just the first two trading days this week, the market was concerned about the Delta variant. A little bit better news, obviously, as you guys were talking about, with the full FDA approval for the Pfizer vaccine, but also, better news coming out of Arkansas and Missouri in terms of the number of their COVID cases related to the Delta variant started to turn down. So, right now, I think the market is still, having this tug of war. It can vary on any given day, whether it's an employment report, whether it's a GDP report, whether it's Delta news. And so, our recommendation to clients right now is, it's not very exciting, but I think you need balance. I think you need to have, a portion of that portfolio with those good long-term growth areas. Should the economy start to slow down, maybe later this year, in the next year, where do you go when growth is scarce? You lean into growth, you lean into large cap growth, you lean into innovation, in areas like technology and healthcare. But, I think there's a case for, some inflationary pressures out there. Certainly anyone renting, anyone owning a business, wage inflation is certainly to be reckoned with. And so, should, I think, the Delta variant, we see the same trajectory that we saw in Israel, we saw in India and the United Kingdom. Should that play out here, hopefully, and cases start to go down, I think you see, the potential for the reacceleration, of the consumer, and that leads you back into, the cyclical sectors. That leads, things like energy and financials continuing to lead the way. Which I know balance doesn't, it's not the sexiest answer, but it's really what we think is the best way to kind of position portfolios, because there is so much uncertainty and such a tug of war between growth and value right now.
Rich, so, we literally caught that wind in our sails with value at the beginning of the year. And then, as you said, when the 10-year interest rate started to come down, growth really took over. But you had a lot of experts out there going, oh, growth is dead and we'll see a decade of value only. And growth swung right back, right? I think it caught a lot of people by surprise. But we are looking at possibly a rising interest rate environment with the Fed decision coming down. Is growth really going to take a step back as interest rates go higher, if they go higher?
Yeah, I mean, I think it depends. Why are rates rising? If rates are rising, because the Fed needs to, we're hearing a lot right now about, tapering. We've got the virtual Jackson Hole, Federal Reserve meeting this week. The chairman will speak on Friday. I mean, if they start to taper because, they think the economy is doing, incredibly well, and that pushes rates up a little bit higher, I don't think it's a tremendous headwind, for those longer duration equity assets that fall into that technology bucket, or kind of a legacy tech and communication services with names like Facebook and Alphabet, aka Google. So to me, I think if rates are heading up for the right reasons, it's not going to cause that much stress. We've seen periods of rising rates, and tech is actually one of your top performing sectors. Certainly it's beneficial for the value sectors, and specifically something like financials, because it helps banks with their net interest margin. But it's not the worst case scenario if rates are heading up, for the right reasons.
So, Rich, you mentioned the value first growth story, and in the large cap sector, growth has clearly caught up. Right through last week, the growth sector was up 17.7 and trailing the value only by 1.2%. But the story hasn't been the same on the small and mid sectors, where the small value is up about 20% for the year, and the small growth is only up 1.2. So could you explain the dichotomy between large cap and small cap, and why they're so different?
Yeah, so I mean, small caps, I think it's small. There's really, if you want to get a gauge as to what the stock market thinks about the economy, I think you look at, the small cap indices. So you look at the, the Russell 2000 or the S&P 600, and there's some concern from the stock market because the small caps, especially small cap value, they haven't made a new high since really the middle of March. And so to us, that's a little bit of a pause that you had a really big run up, 40 to 50%, depending on the strategy and where you were in the small cap space. Certainly, is not uncommon to sort of see, it kind of take a breath with all the other issues, that we talked about. And the biggest move, from sort of the vaccine announcement on November 9th until the middle of March was really in the more small cap value based sectors, a really strong rebound in financials, really strong rebound in industrials, really strong rebound in consumer discretionary. I think most folks are always familiar with, large cap consumer discretionary names like an Amazon or a Home Depot's or a Lowe's or a Nike. But, down in the small cap, you've got, some areas that were, benefiting from the resurgence, of folks feeling a little bit like we were, back to normal. There's Hilton, there's Rent-A-Center, there's PVH, which owns Tommy Hilfiger, and Tapestry, which owns Coaches, as people were back out, shopping and doing more things, in person. Over on the small growth side, you've got a bigger weighting in healthcare, which is certainly a sector that we talked about last time that has rebounded nicely, but it's really rebounded a lot right now, driven by either large cap pharma names. Pfizer's done incredibly well this year, and then also a very narrow subset of the biotech space. Specifically, the mRNA vaccine providers, Moderna, BioNTech, which partners with Pfizer to make their mRNA COVID vaccine. I mean, just incredible, performance out of those stocks this year. And so if your fund or your benchmark didn't own that, you're kind of lagging behind. So small growth has been, definitely a little bit of a weaker area because tied to the, you're tied to the economy, but you don't have perhaps the staying power or the diversity of your business line, that you find, with some of the FANG names, in the large cap growth space.
So Rich, to your point, we've been waiting for a 5-10% pullback in these major indices, but the Russell really has done that already. And so we're starting to hear that this actually might be going forward, might be a place to start allocating some dollars, maybe, dollar cost average in, not all in one day, but maybe the opportunity is in this space that you're talking about.
Yeah, no, I think, a quote that I'll share with you from one of the portfolio managers at Fidelity that we heard when we talked to them just a few weeks ago was, you need to have that exposure to small caps because when they move, they're going to move pretty quickly. Very hard to time that movement, in small cap. So, it could be any one of the catalysts that we've talked about that causes, kind of that resurgence. And, you can just look at, I was looking at it from a sector lens, but, energy stocks were down 7% last week. And, in the first 2 days this week, they're up almost 5%. So, whether you talk about cyclicals, you talk about small caps, I think you need to have that exposure because when they move, they're going to move quickly.
So to your point about that, nothing's really changed in the energy sector between this week and last week. So when that happens, is that just computer models stepping in and just triggers going off that there are buy signals?
Yeah, I would say it's a combination of some algorithm trading, but also a lot of times hedge funds, investment banks, just kind of moving some of their positions around quite quickly that put some pressure on the stocks. Hard, I think, sometimes for long-term investors to stay away from the daily movements, especially if it's a position maybe you just put in the portfolio or just entered into because you're kind of excited about it. It's you're like a new thing to keep an eye on. But I think some of the best things we can do is just understand why we've got that position in there and give it time to to kind of play out. It can be, like we talked about last time, it can be that discussion around healthcare stocks where from essentially November to March, they didn't move. Everything else was working, but healthcare stocks weren't. Well, we wanted to stick with it. Valuations look good. Innovation looked good. Opportunity in the space looked very attractive. So, there's, I think if your investment thesis is sound, I think one of the best things you could do is, just stick with it for a little while, let those ideas play out and stay away from the short-term noise, especially too, the other thing to think about right now, and maybe part of the reason, I mean, this is historically a little bit weaker time for the market, but it's also a little bit slower time, as folks are kind of wrapping up the summer, still a little bit of vacations out there, volume a little bit lighter this time of year, and that can exasperate some of the moves that you see as well.
Rich, you brought up financials earlier in this conversation, and obviously they've done well so far this year, but you look at the amount of money that these banks, primarily the big banks, have in deposits, and they're making very little interest on it. They're making very little profit. They're obviously paying even less out to the consumers. And loan demand has just dropped off a cliff. I mean, I saw a stat yesterday where 30% of all homes purchased so far this year were cash, 100% cash with zero financing, all-time high. Where are the banks going to make money if the deposits they have aren't really making them any money, and loan demand is way off, just falling off a cliff? How are the banks going to make any money?
Yeah, so I mean, I do think the consumer, no doubt, is probably better positioned now than when we entered the downturn, but a lot of that support is about to roll off here soon. We are starting to see, a slight tick up in credit card usage. So I think the consumer, might start coming back, to their bank for maybe more equity lines of credit. I think, as you start to see businesses, increase production, I think there's certainly, a catalyst there for lending activity. But I think the big case, behind the banks is, this is, as healthy and as attractive as their, balance sheets have ever been. The regulatory pressure, I think, has abated in terms of, who's in the spotlight right now. It's, you pick up the, Barron's this weekend. It's the technology companies, it's the FANG companies that I think Congress, has their eye on. So you've got this really good balance sheet. You've got less regulatory pressure, opportunity then to increase, share buybacks, increase dividends. I also think we'll see a continued activity, in the M&A space. Probably, not at the major level that, some of the names you mentioned before, but think about some of those regional banks, in your area. There's certainly been, a lot more consolidation there in the Southeast. We're seeing it in the Mid-Atlantic here, even into Texas, where I live. And then, don't forget too, there's consumer finance inside there. We've got a really strong, housing market that I think can, certainly help the banks. Banks are, they're moving more into asset management, wealth management, which, delivers a much more consistent, earning stream. And so you tie all those things together, and then, if we see rates move back up, we get a little bit steepness in the yield curve. I think you add all those things together with the sector that still, when you look at all 11 of them, is the cheapest in terms of valuations. It makes a compelling case, to make sure financials are, a portion of your portfolio.
So Rich, we're running out of time. So let me ask you a more global question. I know Fidelity, the way you guys manage money, it's not one voice like some investment houses. You guys kind of have a committee. So what's Fidelity nervous about as we end towards the latter part of 2021?
Yeah, I mean, we firmly believe we are, in the mid-cycle portion of the of the business cycle. So, the good news there is, listen, being in the mid-cycle is still a very historically attractive return space for equities. It's not quite as significant as it is coming out of, a recessionary environment or in the early stages of the business cycle. Think of that, May, June, July time period, where we exited the recession, and just, the stock market was very strong, but it's still, above average historical returns, for the equity market. I think the risk is, a slowdown in growth, any breakdown in the, any breakdown in the credit markets. And then, maybe the one thing that we didn't talk about, but, is I know everyone knows is so important is, the E. We talked about valuations a little bit, but, do you start to see, an earnings growth slowdown, and you start to see, earnings peak or profit growth peak. And so, to me, that's probably the biggest wild card out there. If we continue to see earnings grow, right now you're seeing 2 out of 3 companies, increase guidance. For every one company that's actually lowering their guidance, if earnings remain robust and strong, then I think this is an extended, mid-cycle period, where we have, good growth, not inflationary pressures, and you can actually start to see, where we started, on this discussion. You can actually see those legacy technology, healthcare, growthier names work alongside, the more cyclical names inside the, the financials and energy space. That, hopefully doesn't have to be this, one's winning, one's losing. You could enter, a good period of solid returns, across the board. Might not be the 40-50% that we've seen in different moves, but right now the S&P, it's trending towards almost a 30% return. So nice to see you could see an environment where the market starts to broaden out.
So Rich, we are out of time. With your permission, we will have you back towards the end of the year to see how we did with some of these predictions. And as always, we appreciate your time this evening.
Sounds good. Thanks for having me.
Thank you, Rich. Have a great evening.
We'll be right back after this break. When you're thinking about where to park your cash, for over 30 years in the business, I've been a fan of funds like the Lebenthal Ultra Short Tax-Free Income Fund. It's managed for cash and designed so the interest income you receive is free from federal taxes. And who doesn't love paying less taxes?
Mike, generating interest that's free from federal taxes is appealing, but I've been in this business for a long time, and people love the potential for more income on their hard-earned cash.
Sorry, Dom, but the beauty of the funds is paying less taxes on cash.
No, my friend, it's the potential for more income.
Less taxes.
More income.
Less taxes.
More income.
Less
for
taxes.
your cash.
More income.
Ask your advisor
Less
about the Lebenthal
taxes.
More
Ultra
income.
Short Tax-Free Income
Telling you,
Fund.
less taxes.
Or find out more at dcmadvisors.com.
Well, Dom, one thing I know we agree on, it's not what you earn.
It's what you keep.
Lebenthal Ultra Short Tax-Free Income Fund. Symbol LETAX. LETAX. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
And welcome back to the Lebenthal Report. I'm Jordan Kimmel, Chief Equity Strategist and Portfolio Manager. And it is a delight to bring on a good friend, an old friend from a little far back, Barry Seidel. Thank you so much for joining us.
Thank you for having me, Jordan. It's a pleasure to be here with you.
So let me just share for our viewers, I do know you for a very long time. You've had a really interesting, great career in the law industry. It's not my favorite industry, but you've had a way to kind of evolve. And we caught up last night, Barry. You know, we mentioned that, you know, the Darwin theory was not about the strongest survive, but the ones that evolve the most and adapt the best survive the best. And so it's a great time to just bring you on to start by, please mention your book. We're going to show it on the video. It's got a great title, and talk a little bit about the evolution that you've had.
Well, yes, I started out back in 1982, graduated from the University of Texas Law School, and found that coming back to New York, I wasn't able to get a big time corporate job in New York. And maybe I wasn't really the right fit for that. But I didn't let that discourage me. And at the time, I came across a book called How to Go Directly into Solo Law Practice Without Missing a Meal. It was written by a lawyer in California. He had a little plan for starting a practice right out of school. I took a look at that book and I said, you know, what he did in LA, it would work better in New York. And I decided to give it a try. And 38 years, still haven't missed a meal, and evolved through various different areas of practice over time, and made a nice career for myself. 38 years, still doing it.
But share, Barry, the name of your book, because I think it tells the whole story in a soundbite.
Yes, my book is Evolutions of a Law Practice, How I Started my law practice right out of law school and lived to tell about it. And it actually turns out to be quite appropriate for our current times and situations, because in the book, it's a memoir, and I talk about the different areas of law that I tried and how I adjusted and pivoted along the way. I experimented or did 6 or 7 distinct areas of law, and I was at a certain point of time in March of 2020 when all of a sudden the rug was pulled out. And I found that I had to evolve once again, except this time it's a little bit different because evolutions usually happen slowly. And this one happened suddenly, and much of it for the good. And I think a lot of people are finding that they had to make quick decisions, or at least a lot of people did. They had to step back and have a little bit of perspective. Where am I? What do I have? What are my assets that I'm holding? What would I really like to do? And sitting around and getting to think about that for a good number of months last year, gave me the opportunity to plan some new things and evolve relatively quickly compared to the usual evolutions.
Right. Well, Barry, you know, the last couple episodes, interestingly enough, we've had on guests talking about how stay at home, work at home, that whole transition took place. You were actually ahead of the curve in terms of helping in the suburb of Forest Hills, New York, great place, where really helping lawyers be somewhere that they weren't then. You were ahead of the curve. You transitioned again ahead of the curve. And so I give you so much credit for that.
Thank you. I saw at a certain point in my career, I'm going to say 8 or 10 years ago, that technology for lawyers in regular general practice and in the non-corporate world, people doing regular things, whether it's accident cases, divorces, estates, immigration, all of those things, lent themselves very well to technology. I wasn't the only one who realized this. Lots of people did. Legal tech is a huge industry. I was an early adapter of cloud-managed, cloud-based case management. I was an early user of something called Clio, and I've been using it for about 8 years, so that when the pandemic hit and people were working from home, well, I had an office, but I was working from home a lot and remotely anyway. I had an associate attorney and a paralegal who were coming into the office, but they were Clio users also. And so when we needed to work at home for a while, we were able to do it pretty easily. And I found that my two employees both kind of like it. One likes it more than the other, but that's okay. And everybody's got to find their level of home and office. I really like working from home. It's been great for me. I find it much more productive. I can set out blocks of time and work quietly. And when you have an office and people are coming in and talking, it's hard to do that. So I have found this is my next evolution came suddenly, but I've been kind of liking it.
Right. And so, Barry, we talked last night, we got to catch up, and I'm really glad. I love your family. I love you, frankly. I think you're a great guy. But, we talked about something that maybe we could bring it into the Lebenthal discussion. While you do lots of things, one of the things you shared with me is the probate process, issues you've had. So at our firm, we do financial planning. We talk about not only beginning the process, but completing that process. And you started sharing a story or a couple stories about probates that didn't go so easily because they weren't completed properly. And maybe, it'd be great discussion.
Sure. There's quite an interplay between the main practice area that I've been focusing on the last 10 years, which is probate and estate administration. Now that's distinct, but related to estate planning. So a lot of the cases that I have start out, somebody died and then. And when that happens, there's three yes, no questions in every case. There's a will or there's not. The situation's friendly or it's unfriendly. I'm being asked to represent the fiduciary, the person handling the estate, or someone affected by what the fiduciary is doing or not doing. I know quite a bit about, even though I don't practice directly in the area, about estate planning, something that anybody with any assets at all should be doing, if for no other reason than to end up in one of the crazy situations that end up in my office. I kind of like what I do. That's why I do it. But I'm very familiar with what goes on in the estate planning area. I refer matters to estate planning attorneys all the time. And I would say there are two sort of subcategories of that kind of work. There's more of the high-end tax planning, estate planning, pass on to the next generation planning. That's a kind of a specialized area, and it's appropriate for a lot of people. However, there are many middle class, upper middle class people who can benefit from that somewhat. But even more than that, there's a whole area of a different type of estate planning, which I call Medicaid planning, which is what moves can I do? What consultations, what documents can I prepare and file to avoid a disaster lurking over a lot of families of some means, which is, God forbid, somebody, a mom or a dad, ends up in a nursing home and it wipes out their assets and it wipes out everyone's inheritance. It doesn't take many years in a nursing home where someone hasn't planned to have that happen. I see it a lot.
And so, Barry, while we help a lot of high net worth individuals, a lot of our practice are individuals that have built their own practices that came from where we came from, maybe state schools, built up a net worth, built their own businesses. Those things actually, over time become surprisingly valuable. And without the right planning, without the right execution of the lawyers to really see it through the process, sometimes you think you have it done, but it's not completely done.
Well, that's a related issue. I mean, people should seek out expert counsel for those things, not be afraid to invest a couple of bucks to do it right. And there's a related thing to that. And when I think what you were referring to earlier, where people don't do it right, I've encountered lots of situations where people did fancy estate planning with expensive lawyers, and they only took it to step one. People can set up trusts that would be great at transferring assets, but you got to put the assets into the trust. And there's lots of reasons why people don't. And sometimes they put most of it in, but not all of it. Sometimes it's a question of maintaining control. Sometimes they acquire an asset later through inheritance, through continuing to work, through business, through selling something. If it's not in, it ends up basically in my office going through the regular probate system. Not that there's anything wrong with that. The probate system works. The stuff ends up going where it's supposed to go.
Right.
And
So Barry, let me say this, you were a leader back in school when I knew you. People look for you for guidance. And I've also mentioned at the beginning, you've evolved a couple times. I'm going to actually throw the door open here for you to maybe talk about something that I can't even think about asking you, something maybe that you're doing in your practice, maybe that people should be thinking about, that you're handling for people that maybe I couldn't even think to ask you.
Well, I mean, when you talk about evolving practices, I'll talk about where I was when the pandemic hit, just as an example of how you can't be so locked into something that you can't adjust to new things, which we've all had to do. When the pandemic hit, I was doing a little side hustle, which was really the main part of my business. It was a service business to lawyers where I covered cases in Queens Supreme and civil court for other lawyers. It was a service business that evolved from noticing that the court system was very efficient. They had all these dopey appearances. Attorneys didn't want to go. I figured out a way to market it. I built it up. It was the main part of my practice. However, I never thought it would last forever because it was based on inefficiencies in a court system that I knew eventually would get better. At the same time, I kept the private practice area, which was the probate and estate stuff, and it was about 30% of what I was doing. Since March 20th of 2020, my per diem business, which was a very successful business, has been a zero. Courts are essentially closed. Not only that, they haven't really reopened. I saw in April or May of last year that the little bit of virtual that the courts were starting to do was going to work. And all of the stuff that I thought was going to evolve gradually and over time, maybe I'd retire with my per diem appearance business fading into the sunset. But all at once it became a zero. And I had to decide what to do. Some of my colleagues didn't see that it was zero and are collecting unemployment and waiting for it to come back.
Right.
It's not going to come back. So what I did was I took my 30% of my practice, that was the probate and estate stuff that I kind of liked. I looked at, well, I've got a reputation. I know how to do it. I've got staff that knows how to do it. Actually, one didn't so much because she mostly worked in the court business.
Okay.
So we switched her. My associate and I said to her, listen, Barry has concluded. I have concluded the court business is probably finished. She's a great worker. I'd love you to stay with me. Would you like to learn to do the probate with us? Which she kind of knew a little bit. So we did that. And it took a while, but I was confident the whole time that it would go from, all right, it's going to be tough. It's going to be tough. It's getting a little better. It's getting a little better. Hey, I kind of like this. I really didn't like the court business so much. I was solving a problem for other attorneys. Here's what I used to say to some of my friends doing the business. We used to say in the court appearance business, bad is good. The court system is bad for attorneys. It's good for us. That was true to a point. At a certain point, bad becomes so bad, it's intolerable. And I realized in hindsight, when I stopped doing it and sitting at home and having perspective, I was kind of glad to not be doing it and to be what I call like a real lawyer doing a practice area that I like. It's been okay. And actually more than okay. It's been fantastic.
Well, Barry, I mean, that's the old side of you that I know. It's the point guard side that knows how to distribute, that knows how to adapt. And what I have to say is that we're both still pretty young. I love what I do. It sounds like you're really catching another wave. Maybe we could help some people in our own way together, but we have a lot of common friends. We got a lot of common history. I love your story. We're going to wrap up this segment. I want you once again, we're going to show the book on the video. Remind us the not only the book, but anywhere if anyone wants to find you, where we could find you. Oh, there you go.
Evolutions of a Law Practice, www.evolutionsofalawpractice.com. It's available on Amazon. And I think it's, people tell me that it's a good read. I like to joke around that this book, it's a self-published, and it came out in December of 19, right before the pandemic. So I could say I was about to go on a nationwide book tour, but it was interrupted by the pandemic. Okay, maybe that's not exactly how it went, because I was actively in practice and doing what I'm doing, but I'm very proud of the book. And people who are not lawyers that have read it have told me many times that they really like it, because it's not just a story about law practice. It's more, how do you approach business, entrepreneurship, problem solving, making changes and adjustments, and learning things along the way. I'd say that's the biggest theme in the book. Is I realized when I wrote it, I was very naive when I started, but I didn't know it at the time, so it didn't scare me. Looking back, I don't even know how I did some of the things that I did, but I did them using something that I use to this day, which is, you have an idea. I like to say, when you do things, things happen, often unexpected things, and almost always good things. So all throughout my career, as I evolved in into different areas, I would try some little marketing idea. Sometimes they worked. Very often they worked, and very often in unexpected ways. Sometimes amazing ways too.
Well, Barry, I love it. You're a good guy. You're a great guy. You're a great friend. I'm so glad to have you on today. We're going to wrap up this segment. We're going to be right back with more of the Lebenthal Report, and we'll be in touch real soon. Thanks once again for coming on.
Thank you so much for having me. I really enjoyed it.
All righty. We'll be right back with Mike and Dom to wrap up the show.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
And I'm Michael Hartzman, back with Dominick Tavella. You know, Dom, Barry Seidel made some very good points at the end of that segment about documentation. Check it twice, check it a year later, make sure it's still what you want. As we were saying on the break, how many times have we encountered a family member calling up with mom or dad literally on their deathbed, and we're scrambling to change whatever it is they want to change?
Look, it's an unfortunate reality, especially now with COVID, and is now a year and a half plus into it, and we get these calls on a regular basis. Both of you and I have been practitioners for over 30 years, so we've had clients who are basically like our own families, and they do pass away, and then we find out later on that the trust that they had created, they spent a lot of money, wasn't funded, that assets weren't transferred, that a beneficiary form wasn't changed, that they have life insurance policies with spouses' names on them that weren't updated. We can go on, right, Mike? And it's so important that you look at these documents on a regular basis. It doesn't have to be once a year, but every 3, 5, 10 years. Look at these documents, and I'm going to stop talking so you can pick up the ball on this one, Mike. But we beg clients to bring these documents into us. Let us review them. Let us help you. And it's really an important part of our practice.
Yeah, and the other part of that, Dominick, I had an interesting experience a month or two ago. A client of mine, a friend of mine, his dad set up an irrevocable trust, and unfortunately wants to cut out one of the beneficiaries, which is one of his children, unfortunately. And, you know, my friend is the trustee. And you know, you create an irrevocable trust, it's really, really difficult to unwind that thing. So I think the other part of it is, you know, clients go and talk to people like Barry and our friend Harold, but they quickly forget what they've actually committed to do. And these trusts really take on a life of their own.
And I'm sure it's happened to you as well, Mike. Clients will bring these trusts in and we'll go, what is it that you exactly wanted to do? Mm-hmm. What is it that you think you did? And of course, we read these documents and then speak to the attorneys. It's not what the client had in mind or what their understanding of it was. And it becomes a challenge to sometimes to unravel some of these things that they went ahead and created. So it's so important to bring an expert like Barry in, or so your attorney. We don't care who you counsel is, but bring an advisor that you trust in. Have your partners, your wealth planning partners, your attorney, your CPA, your financial person, all in the room or on a conference call, and make sure everybody's on the same page and you clearly understand what it is that you're trying to get done.
Yes. And the other part of that, Dominic, which really never gets really paid much attention to, is we've had a really, really, really good stock market. So one of our clients could say, I'm going to leave 5% to so-and-so charity. And 5% 10 years ago may have been $50,000. And 5% now may be $500,000. And that's the other part of these documents that need to be reviewed is, are you still comfortable leaving, X amount of this large amount of money to a charity? Number one, do you still like this charity? Number two, this is a larger sum of money. So is this still your intention?
And you still might like the charity, but you may not like the child in the case that you brought up. So again, this is who you named as your beneficiaries, right? This is who, or TOD, transfer upon death form. This is who you want these assets to go to. Is that still your wish? And if you want to change it, sign the form. Stop talking about it. Sign the form. We're agnostic. We don't care. But our job at the end of the day is to make those wishes, if possible, happen. And too often those things slip through the cracks. Then we get the phone call. And I've had the unfortunate experience over the last several months to go, I know this is what he told you. This is not what the signed piece of paper says. And our hands are clearly tied.
No, they absolutely are. So listen, we're just about out of time. Next week, we're going to cover a topic, Dominic, that we never covered, which is really super important, and that's Social Security. So Nationwide got us an expert, and we're going to go through all of the permutations of Social Security, 62, full retirement,
I love it,
age
Mike.
70.
We get questions on this all the time.
All
It's
the
such an
time.
important subject. So great stuff.
Great stuff. And if you're out there, I would encourage you to join us next week as well. And Dom, we are officially out of time. You
Again.
stay well, and I will see you down the road.
Be safe, Mike.
Have a good night, everybody.
Thanks for tuning in to the Lebenthal Report. Dominic, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.